Many people commented about the US dollar dropping. It's definitely no longer as strong as before. And looking at how Trump responded, he said the dollar is at a good level right now and he's not worried about it. So, looking at some comments from Morgan Stanley, you need to see the distinction between a controlled decline or a disorderly one. What they're saying is currently the dollar weakness is going through a controlled decline, which makes sense for what Trump's strategy is. The main goal for US moving forward is to rebalance the US economy and get out of the huge debt burden that has been compounding for more than 2 decades. So, the way to do it is to rebalance trade through tariffs and also a weaker dollar. US trade deficit is very steep. Exports are way lower than imports. That's also the biggest reason why Trump wants many US companies to relocate their manufacturing plants back into the US. When that's the case, they can start to export more, sell more than buy, which is important. Then on, the trade deficit will slowly reduce the gap between the two. So when the strategy is to export more, you cannot have a strong currency. Currency needs to taper downwards. So other countries that import from the US will feel less of a pinch. This is what the US administration is doing. And other than this big one, a smaller one is to address inequality through immigration and then some deregulation that you can see in the finance industry and a portion of tech. The whole point is to let companies, and not the government, make capital allocations decisions and to boost income through wages, meaning allow companies to be more sustainable on their own rather than relying so much on policy changes. And so, to have growth driven by productivity. Markets more or less have already started to price in this. People who caught this already priced in. Cyclical stocks are starting to outperform, and the small and mid-cap stocks are starting to pick up. However, at the same time, markets are still not very confident about what's happening. That's why you see the surge in gold prices. Throughout 2025, gold jumped about 66%. Precious metal don't move like this unless investors are questioning the endgame. The recent Kevin Walsh's nomination as the next Fed chair, which we'll only know the conclusion in April or May this year, that restored credibility, which is the biggest reason why you saw the sell down in gold apart from profit taking. One simple but powerful proxy to track confidence is to look at this ratio of S&P 500 against gold prices. Watch how the market responds, meaning the movements of S&P 500 and gold. That's the best approach, which keeps Morgan Stanley bullish in US market this year. This is one of the indicators other than a labor market and inflation. To the euro area side, European Central Bank didn't change interest rate. As expected, it's currently sitting at 2%. Some comments from them is the economy is still resilient, unemployment is low, private sector is solid, and there's the gradual rollout of stimulus, especially in Germany, which is also heavily linked to defense and infrastructure. And also the previous interest rate cuts have been helping so far. But at the same time, the outlook is still uncertain because of trade policy and geopolitical tensions, particularly around tariffs and also oil. So then, the central bank said they'll maintain being data dependent and didn't hint much about any interest rate cuts in the near term. The Eurozone's inflation is lower than their 2% target. The latest number is standing at 1.7%, and that's for January. And adding on to the appreciation of euro, this will bring disinflationary. This is what they don't want. Look at what's happening to China. And whenever a currency appreciates too much, it pushes the economy into disinflation because imported goods, raw materials, and energy become cheaper. The bigger problem is if this carries on, it'll trigger economic stagnation, meaning consumers will hold off in purchases because their mindset is why buy now if I foresee prices will continue to decline. Let's wait a little bit longer before I commit to the bag ticket items purchases. When that's the case, businesses will see lower revenues. Euro is almost up 14% over the last 12 years versus US dollar. Some ECB policymakers are concerned about this appreciation rate. If this carries on, markets are thinking that an interest rate cut might come in sooner than later. This allows corporates to have an easier environment regarding getting capital to sustain and grow. So, all of these aren't bad news. Before we touch on what happened, let's do a quick wrap-up. A comment from Morningstar, which is very nicely said. Despite the sharp drawdown, investors see the sell-off as a correction rather than the spark of a downward trend. Looking at broader Hong Kong and China equity markets, the weakness appears to be concentrated in pockets that had recently outperformed. It's natural to see profit-taking activities. What caused the sell-off is recently there are concerns about tax. Tax worries are point 1. Point 2 is global risk aversion. So Hang Seng Tech Index, which is mostly China's Hong Kong-listed technology stocks and mostly dominated by mainland Chinese tech companies, was down for 6 sessions. Markets are worried about the possible increase in value-added tax on internet services providers. There's already some VAT tax increase that happened on telecom services companies. That's why markets are worried about the same thing could hit the internet services providers. And on top of that, recently in early February, global tech companies saw some sell-off like you can see here at the chart on the right. You can see S&P tech companies experienced a sell-off because of concerns on capital expenditure. A lot of capex that big cap companies published were way higher than what analysts estimated. Hence, that triggered a sell-off. But the level has since picked up already. Other asset managers say that fundamental outlook for Chinese tech is still steady. It hasn't really deteriorated, and the outlook is still positive. Valuations continue to be supportive. Sectors' earnings still have potential to rebound. They'll continue to ride on the AI boom. So again, like what Morningstar said, this is just a temporary correction. And so last one, Japan election. Other than Japan, Thailand also had an election victory. But looking at Japan, which is a bigger market, Prime Minister Takaichi won, which is more or less expected. Then you see Nikkei 225 reflected the optimism. Investors, broadly speaking, feel that Prime Minister Takaichi will bring Japan's economy to a more growth-focused direction. Particularly, there's been talks about policy and stimulus, strategic investments, and tax reform. The tax reform more or less revolves around food consumption tax, which will drop from 8% to 0% for 2 years. Consumer staples will likely see a boost in sale because the tax relief allows households to spend more, and fiscal stimulus will be strategically targeted to create opportunities across consumers, industrials, and defense-related industries. But that doesn't mean it's all good. Markets are still concerned about tax cut. The tax cut will reduce the government's revenue by about $32 billion per year, and that will happen for 2 years. Consumption tax is a key funding source for Japan's government. So the question is revolving around how is the government going to fund the stimulus? If they want to issue more government debt, according to IMF, Japan already has the world's highest debt to GDP ratio at about 230%. This concern will continue to linger. Markets will see how the new government team will roll out each of the plans that they mentioned.